Are you interested in turning your home into your dream home? In this video, I'll discuss 3 different types of mortgages which allow you to use a mortgage to fund your dream home renovations. Thanks for tuning in to another episode of Mortgage Sense. Today, I'm discussing the 3 different types of mortgages used to fund home renovations and some basic rules around each. The 3 types offered by lenders are home equity line of credit, a refinancing or taking out a second mortgage on your property, and the purchase plus mortgage option. The first 2 options involve withdrawing equity out of your house, while the purchase plus option allows us to add the cost of our completed renovation project to our mortgage, and I'll explain more on this later. But let's break down our first 2 options: the home equity line of credit, or HELOC for short, and the option to refinance our current mortgage or take out a second mortgage on our property. The maximum amount of funding provided by these 2 options is determined by our income and what's known as the loan to value ratio. We're not going to discuss the income requirements in this video, but I would like to discuss the main limiting factor within these programs, which is this loan to value ratio. The loan to value ratio is a ratio on how much our outstanding mortgage balance is to the current fair market value of our home. So if we have a home worth $500,000 and our outstanding mortgage balance is $250,000, our loan to value is going to be 50%. Now remember this 50% number because we will be using it in our later examples. So option 1, home equity line of credit. A home equity line of credit is an excellent way to fund our renovation project because it is extremely flexible. Lines of credit allow us to withdraw money as we need as opposed to taking it as a lump sum. But they do have a bit of a downside. Mortgage rules dictate that the maximum loan to value allowed on a home equity line of credit is 65%. So if we apply this rule to our scenario, it will look like this. Let's take the maximum loan to value allowed of 65% minus our outstanding loan to value of 50%, which equals 15% of usable line of credit room. Now if we apply this 15% to our home, which is valued at $500,000, that equals $75,000. So the maximum line of credit that we can request is going to be $75,000. But what if $75,000 isn't enough to accomplish what we want to get done? That is where option 2 steps in, refinancing our current mortgage or adding a second mortgage to our property's title. Mortgage rules used in these programs allow us to refinance up to a maximum loan to value of 80%. But unlike the line of credit, this option requires us to take the full amount requested as a lump sum. So after we finish setting up this mortgage, the funds are going to be transferred to our account and we will begin making the required payments. Now let's apply this maximum amount to our scenario. As I mentioned earlier, the maximum loan to value allowed with this option is 80%. We'll then deduct the current loan to value of 50% and we have a usable amount of 30%. Then we'll apply this 30% to our current home valued at $500,000 and we generate a maximum amount of $150,000. So with this option, the maximum amount that we can request is going to be $150,000. You may be asking me, what's the difference between refinancing and taking out a second mortgage on the property? In short, lots, but that's a movie for another day, so stay tuned. Okay, so far we've covered our home equity line of credit option and our refinancing our current mortgage or taking out the second mortgage option. Now, let's check out the purchase plus mortgage. The purchase plus mortgage is unlike the others for a few key reasons. Firstly, this option is meant for prospective homeowners, not current homeowners, and the program is available to high ratio mortgages as well as conventional mortgages. To really explain the benefits of this program, I'd like to give you an example. If we decide to purchase a home for $500,000, the bank is going to recognize the amount this home is worth and transfer the required funds to complete the sale of this home. With the Purchase Plus program, everything stays the same, except now that we own the house and we've completed our desired renovations on this house, the bank is going to add these costs of renovations to our mortgage and release the remaining funds to us. If we are using a high ratio mortgage to purchase our home, meaning our down payment is less than 20%, the bank will recognize up to $40,000 of renovation costs. If we are purchasing a home with a conventional mortgage, so a down payment of 20% or more, the bank will recognize up to $60,000 in renovation costs. So really cool program. So there you have it. 3 options to fund your home renovation project and allow you to turn your home into your dream home. If you have any questions or would like to take advantage of these programs, I am located in Vancouver, BC. Please give me a call at 778-215-4121, and thank you for watching.